I figured out how to start investing so fast it feels like cheating. And no, I am not talking about some crypto bro on Instagram flexing a Lambo he rented for a photo shoot. I am talking about a mathematically proven system that takes 15 minutes to set up and historically beats 94% of professional Wall Street fund managers over 20 years. Not some of the time, over 20 years. But before I show you the cheat code, I need to talk about the dumb way first. Because there is a very good chance you are either doing it, about to do it, or paralyzed in fear because you watched someone else do it and blow up their account. You have seen it. A friend, a coworker, maybe a cousin, starts yapping about a stock they found, or a crypto play, or options, or some leveraged ETF. And for a few weeks it works. They are texting you screenshots, they are talking about quitting their job, and you are sitting there thinking, maybe I should get in on this. And then one of two things happens. Either you get in right at the top and watch it collapse, or you stay paralyzed and watch from the sidelines, feeling like an absolute idiot either way. That loop, that exact loop, is where most normal people lose money or lose time. And both of those are losses you cannot get back. Here's the hard truth. Day trading is not a career. It is a statistical trap designed to make you feel like you have a shot while quietly emptying your account. Look at this. Researchers studied every single transaction in the Taiwan stock market from 1992 to 2006. 15 years of data, every trade. And what they found is that less than 1% of day traders reliably earned positive returns after fees. Less than 1%. In Brazil, they tracked 19,646 people who started day trading between 2013 and 2015. Of the ones who stuck with it for more than 300 days, 97% lost money. 97. Only 1.1% made more than the Brazilian minimum wage, and only 0.5% made more than the starting salary of a bank teller. A bank teller? These people are sitting at home staring at charts all day, taking on extreme risk and volatility, and statistically, almost none of them are earning more than someone who just showed up to a branch and processed deposits. And it is not just bad luck. The math makes it nearly impossible. Every trade costs you money before it even has a chance to work. Bid-ask spreads eat between 0.1 and 0.5% every single round trip. Slippage costs you another 0.1 to 0.3%. And exchange fees on top of that. The hurdle rate just to break even is higher than the historical annual return of the S&P 500. You are running uphill before the race even starts. In Taiwan, the total aggregate losses of individual active traders were equal to 2.2% of the entire country's GDP. That is how much money regular people handed to the market through overconfidence and bad strategy. You are not going to be the exception. Stop thinking you are going to be the exception. So here's the cheat code, and it is embarrassingly simple, which is exactly why most people ignore it. Cheat number 1. Stop trying to beat the market and let the market beat everyone else for you. Here's what most people get wrong about the S&P 500. They think of it as one boring investment. It is not. It is a self-cleansing mechanism. Every single quarter, the index reviews its 500 companies. If a company is failing, shrinking, losing relevance, it gets kicked out automatically. And a stronger, faster-growing company gets promoted in to replace it. No emotion, no ego, no one holding on to a loser hoping it bounces back. The index fires failure and rewards success on autopilot. You own a piece of every major winner in the American economy, and the dead weight gets purged without you lifting a finger. Now look at the professional competition. Every year, S&P Global publishes the SPIVA Scorecard, which tracks how actively managed large-cap mutual funds perform against this same index. The results are brutal. Over 1 year, about 65% of active fund managers underperform the index. Over 5 years, that number rises to 76%. Over 10 years, 84%. And over 20 years, 94% of professional fund managers, people with Ivy League degrees and Bloomberg terminals and research teams, fail to beat a fund that just automatically tracks the market. And here's the part that really buries them. Among the funds that were in the top quartile of performance in 2018, there was a 0% chance of them still being in the top half by 2022. Zero. The rare winners cannot even repeat their own performance. It is statistically indistinguishable from luck. So if the professionals cannot beat it consistently, why are you paying them to try? Because that is exactly what you are doing when you invest in a high-fee, actively managed mutual fund. You are paying for failure. And fees compound against you the same way returns compound for you. This is the part that should genuinely make you angry. Picture two people. Same starting amount, $100,000. Same gross return, 7% per year. Same 30-year timeline. The only difference is the fee. Investor A puts their money in a low-cost index, ETF, that charges 0.03% per year. That is basically free. Investor B puts their money in a standard actively managed mutual fund, charging 2% per year. 2% sounds small, right? It sounds like nothing. It is not nothing. After 10 years, Investor A has 196,000. Investor B has 162,000, a $33,000 gap already. After 20 years, Investor A has 384,000. Investor B has 265,000. After 30 years, Investor A has 754,000. Investor B has 432,000. The fee stole $322,000. That is 42% of the total potential wealth, gone to a fee that seemed small. And that fee did not even buy you better performance. It statistically bought you worse performance. The financial industry has been legally robbing regular people in plain sight for decades and calling it portfolio management. Switching from a 1% fee to a 0.1% fee is the mathematical equivalent of adding 0.9% to your annual return every year without taking any additional risk, not one single ounce of extra risk, just smaller fees. That is it. Use index ETFs. 0.03%. Move on. Cheat number 2, the time exponent. And this one is going to bother you if you have been procrastinating, so pay attention. Compound interest is not just a math formula, it is a time machine. And the variable that controls everything is not how much you invest, it is how early you start. Look at this. Picture two people. Investor A starts at age 20. They invest $200 per month for 10 years, then completely stop at age 30 and never add another dollar for the rest of their life. Total money invested, $24,000. Investor B starts at age 30. They invest $200 a month for 30 years straight until they retire at 60. Total money invested, $72,000. At an 8% annual return, who wins at retirement? Investor A ends up with approximately $408,000. Investor B ends up with approximately $322,000. Investor A wins by $86,000. Despite investing $48,000 less, despite stopping 30 years earlier, despite doing absolutely nothing after age 30, they win. Why? Because time is the exponent. Every year of compounding early in your life is worth more than multiple years of contributions later. The first dollar you invest at 20 has 40 years to grow and can become roughly $15,000 at 8%. The same dollar invested at 30 has only 30 years to grow and becomes about 7,600. You lose nearly 50% of its potential value just by waiting 10 years. And the rule of 72 makes this even more concrete. Divide 72 by your expected return, and you get your money doubling period. At 7%, your money doubles every 10.3 years. So if your retirement goal is $1 million and you start 10 years late, you are not just missing out on 10 years of growth. You are missing out on one final doubling. Your $1 million becomes $500,000 just from waiting. Every year, you sit here thinking you will start when you have more money or when the market is less scary, or when things feel more stable. You are cutting your final balance in half one bite at a time. Stop being dumb about this. Start now. Even small amounts. The time matters more than the amount. Cheat number 3, automate everything and remove yourself from the equation because you are the biggest risk in your own portfolio. Here is the problem. Even if you understand all of this intellectually, your brain is going to try to sabotage you. When the market crashes 30%, and it will crash at some point, every instinct in your body is going to scream at you to do something. Sell, protect yourself, move to cash. Wait for it to recover before you buy back in. That instinct is called the action bias, and it is the single biggest destroyer of retail investor returns. Researchers studied elite professional soccer goalkeepers during penalty kicks. Balls went to the center of the net 28.7% of the time. Goalkeepers stayed in the center only 6.3% of the time. They dove left or right 93.7% of the time, even though standing still was the statistically correct move. Why? Because failing while doing something feels less embarrassing than failing while doing nothing. And that same broken logic is costing investors a fortune. According to the Dalbar study, in 2024, the S&P 500 returned 25.02%. The average equity investor earned 16.54%. That 8.48% gap, the second largest in a decade, was caused entirely by panic selling, late buying, and chasing trends. On a hypothetical $100,000 balance, that gap cost the average investor over $12,000 in a single year. Over 20 years, a buy and hold investor in the S&P 500 would turn $100,000 into $717,000. The average emotional investor, making reactive decisions, ends up with $345,000. That is $370,000 handed to the market purely through bad behavior. The fix is automation. Set up a monthly automatic transfer from your bank account to your brokerage account. Set it to buy index ETFs on the same day every month. Then do not touch it. Do not look at it during crashes. Do not log in and fiddle with it when everyone around you is panicking. Just let it run. This works mechanically through something called dollar cost averaging. When you invest a fixed amount every single month, you automatically buy more shares when the market is cheap and fewer shares when it is expensive. You do not have to time anything. You do not have to be smart about when to get in. The system rebalances itself mathematically just through consistency. A fintech study in 2022 found that people who automated their investments automated 73% of their total contributions and had dramatically higher retention rates during market downturns. Because the decision was already made, there was nothing to agonize over. The money moved automatically, and the shares were purchased automatically, and the brain was left completely out of it. Automation beats willpower every single time by eliminating the decision entirely. Cheat number 4. Stop giving 2% of your wealth to the government every single year for absolutely no reason. Taxes on dividends and capital gains in a standard taxable brokerage account are essentially a hidden fee that most people never calculate. According to Morningstar, the average U.S. equity investor surrendered approximately 2% of their pre-tax return to taxes annually between 2019 and 2022. So if your portfolio is earning 8%, you're actually keeping 6 after tax drag. That sounds manageable until you run the 30-year numbers. Look at this, $10,000 growing at 8% in a tax-advantaged account like a Roth IRA, or 401k grows to $100,626 over 30 years, with zero tax taken out along the way. The same $10,000 growing at 6% after annual tax drag ends up at $57,435. That is a 43% reduction in your final wealth purely from taxes. You are handing nearly half your potential money to the government because you chose the wrong account type. The cheat is account location. Put your investments inside a Roth IRA or a 401k. In a Roth IRA specifically, you invest after-tax money, it grows completely tax-free, and you withdraw it in retirement tax-free. Every dividend, every capital gain, every dollar of compounding growth is yours, and the government gets nothing. That is a legal loophole that has been sitting in the tax code for decades. High-income generating assets like bond funds and REITs go in your traditional IRA or 401k, where they are shielded from ordinary income tax. Growth-oriented index ETFs go in the Roth, where the compounding snowball runs tax-free forever. Smart asset location, according to Vanguard Research, can add up to 0.75% in net annual returns without changing a single investment, just from placing things in the right accounts. So here's the full system. Stop picking stocks and stop paying people to pick stocks for you. Buy a low-cost S&P 500 index ETF with fees as close to 0.03% as you can get. Start as early as today, not next month, not after the next paycheck, today, because every year you weight cuts your final balance and the math is not on the side of procrastination. Automate your monthly contributions so your brain never gets a vote on whether to keep going. And put all of it inside a tax-advantaged account so the government does not take a 2% annual bite out of your compounding snowball for 30 years. That is the system. It takes 15 minutes to set up. It historically outperforms 94% of the professionals who spend their entire careers trying to beat it. And the main reason most people will not do it is because it feels too boring and too simple to be real. But the data does not care about what feels exciting. The data says this works. And every year you spend looking for something smarter, you are handing your future wealth to someone who already figured this out. If you found this useful, share it with that friend who is still convinced they are going to build a portfolio by picking hot stocks. They need to see this more than you do.